After a busy week for financial markets, we look ahead to a week that is going to be dominated by central banks, the likes of the Bank of England, the Federal Reserve, and the Bank of Japan, all releasing their latest monetary policy decisions alongside inflation data out of Japan and the UK. So those three countries are particularly in focus as we look ahead to a week that looks almost certain to see significant volatility ahead. So let's look at the big ticket items according to Trading Economics. And what we can see is, first and foremost, we're kicking off with a focus on China. Of course, US-China trade talks took place over the course of the past week. We did see a resolution to that, but ultimately it's quite obvious that maybe we shouldn't get too carried away, because the fact of the matter is all they were trying to do was get the Geneva agreements back on the table rather than actually lowering tariffs. And we've seen from Donald Trump that he's talking about sending out letters telling everyone what their new tariff levels are going to be. So tariff concerns are likely to grow as we move forward. Nonetheless, let's see how the Chinese economy is doing on Monday. Then on Tuesday, we've got that Bank of Japan interest rate decision. Markets expecting it to remain steady as is. That also comes on a day where we see the ZEW economic sentiment survey out of Germany. We've got retail sales from the US leading us into a key Wednesday where we've got the FOMC interest rate decision as the headline act, really. But we've also got inflation out of the UK earlier in the day, coming at a time where we've seen weakness in terms of UK data, but strength in terms of inflation. So the Bank of England is going to have to weigh up those two. And the Bank of England don't have to wait too long because we have the rate decision from the BoE on Thursday, leading us into Friday, where we see inflation from Japan and retail sales from the UK. So let's kick off first and foremost with the US, considering the fact that we have got the FOMC meeting taking place on Wednesday. What's notable about this one is that it comes alongside economic projections. Those economic projections should give us an idea on where they think the inflation's going, where growth is going, and where interest rates are going to go. So that adds another sort of bit of spice to the meeting. Alongside that, we've got the likes of the retail sales and industrial production on Tuesday. We've got the jobless claims again on Thursday, Philly Fed manufacturing index on Friday. Now, what we can see here is that by and large, the relationship we've seen recently between markets and the data have been more along the lines of, if we're staving off a recession, we don't really mind too much that it also sort of delays interest rate cuts because the fear of a recession had been really driving down equity markets. And so the gains that we've been seeing in terms of equity markets of late, and you can see it here on the red line with the Dow, have been going hand in hand with expectations of where interest rates will be by year end. This is the 2025 rate expectation, so year end rate under the Federal Reserve. And you can see here, so essentially, if you see strong economic data or you see strong inflation coming out, that points towards a slower pace of easing from the Federal Reserve. The green line rises, and so it boosts the likes of the Dow and the S&P 500 and the NASDAQ. Now, of course, recently what we saw was a weaker inflation metric. And so we've actually seen the expectation in terms of 2025 rate expectations coming off a little bit. So what you're saying here is that when economic data points towards higher rates by year end, markets like it. But the flip side of it is, if it comes from inflation, then it's the opposite relationship. So rate expectations can fall and markets continue to rise if it comes from inflation, because markets don't mind too much seeing inflation under control. They do mind if we see the economic data and the jobs market starting to roll over in a meaningful manner. Now, what we've seen recently is a gradual adjustment away from the idea that we just see, say, one rate cut this year for the remainder of this year, and instead sort of a greater allocation towards the idea that we see three. Now, ultimately, the midpoint is what's the most likely event, which is a move of two 25 basis point cuts to 375 to 400 by year end. But certainly there's a sort of growing confidence that we could see something a little bit more than that. And you can see it's roughly 30% chance markets are currently pricing according to the CME. So where does this leave us this week? Well, the Federal Reserve essentially have to lay out their stall. And the fact of the matter is that as things stand, inflation has been under control for 3 consecutive months now. The month-on-month inflation metrics came in at 0.1 for both headline and core. And so with inflation seemingly under control, it means that the likes of Donald Trump and some of his advisors can put further pressure on Jay Powell to act. Now, he's not going to act. And the reason for it, in my mind, is because ultimately they aren't in a position where they have the full information on the direction of travel for the economy. You could say that inflation is currently under control, so you're able to cut. But if tariffs ramp back up in a month's time, remember the 9th of July, we've got most of those reciprocal tariffs coming back onto the table. If that happens, then all bets are off and suddenly you have to start waiting for data again. So that data-dependent approach ideally will be waiting for data and the economic conditions or the rules essentially underpinning the economy and the relationships with other trading partners stay the same. What's difficult here is there can be a data dependency, and that data dependency can take a few months to see if it sort of filters into the economy. But ultimately, if in a few months' time they then change the rules and ramp up tariff levels and the like, well, then the Federal Reserve's got to wait once again and be data dependent. So Trump wants Jay Powell to cut. He's not going to cut right now. There's an expectation that if he does cut, it may be in September, the back end of the year. Essentially, that's when the easing sort of gets going. And the reason for that is essentially they have a great degree of uncertainty right now. And it's the certainty that Trump could give them that would allow the rate cuts. So it's kind of his own making, quite frankly. Now, in terms of where things stand in terms of the markets, let's just jump onto the S&P 500. We can see here that we've been climbing with this lovely V-shaped recovery. You know, that dramatic decline that we saw in March and April. Well, we're closing in on previous all-time highs of the S&P 500 here, just under 2% up from where we are at the moment. Notably, if we look at the hourly time frame, we have sort of come a little bit below trendline support that we've got here, but the trend has been a bullish one. What I would say is that we're not necessarily seeing these wide swings, these significant gains. It's really quite narrow what we're seeing more recently, and you can see that here. So it's this rising wedge formation, which is very tight in nature, now sort of dropping down below trendline support. I wouldn't necessarily say that that is going to cause me to suddenly sell this market, but certainly if we break the 59.21, then it points towards us giving some of that back. And a lot of it's going to be sort of headline driven as much as anything. By and large, this week, the Federal Reserve, yes, we're likely to see the outlook from Jay Powell. You know, do they cut? Do they not? No, they're not going to cut. And also the outlook when it comes to growth, inflation, the dot plot, a lot of it is conjecture because they don't necessarily know exactly where we're going to be in terms of tariffs, where we're going to be in terms of the economy because of the chopping and changing under Donald Trump. So all of it really needs to be taken with a pinch of salt, quite frankly. But certainly as things stand, the fact that we're closing up on the previous highs, tightening in terms of this rise, it does point towards a potential risk of downside movement if we do break through the 59.21. Until that happens, you know, the trend is your friend, and over the near term, the trend has been bullish, but it's sort of it's harder fought trying to gain ground compared to where we were previously. So then let's look at the UK. Now, the UK has both inflation and the rate decision taking shape. We've got CPI expected to tick up to 3.6%. The core number expected to come in at 3.8%. The monthly metrics expected to drop, but still be elevated at 0.4%. We'll come on to that inflation problem. And then markets expecting them to stay at 4.25 for interest rates on Thursday. We've got retail sales at the back end of the week. Monthly figures expected at -1%, but by and large, you do get volatility over those monthly figures. The year-on-year number expected at 2%. So inflation-wise, we saw this massive bump last time around. A number of causes for this, like the price cap on energy in the UK going up, a number of the measures under the new Labour government essentially got implemented at this time. So a number of factors providing what looks to be a temporary bump in terms of inflation. However, the fact of the matter is we're now in the mid to high threes. And yes, if you look at the May figures from last year, 0.3 on the headline, 0.5 on the core. Yes, you could see a little bit of base effects that could potentially drive down the year-on-year figures a little bit, but markets are expecting 0.4, so we're not expecting to see low figures this time around either. So the Bank of England's kind of stuck a little bit. Now, the flip side of it is that we just saw a raft of data over the course of the past week, and pretty much all of it came in weak. So we saw higher claimant counts, higher unemployment rate. We saw weakness in terms of the latest GDP data at minus 0.3, weakness in terms of the industrial production figure. I think it was minus 0.6 or 0.7. So all in all, it's a story about economic weakness in the UK. Now, you can look back and say, well, the past 3 months, GDP came in at 0.7. So in actual fact, it's a one-off move. And you can say the same for that inflation thing. Is it a one-off move? And therefore, the Bank of England should look beyond it. Potentially, and that's why it's going to be such an interesting meeting, because you really have the two sides of it. You've got a raft of poor economic data, but also this surge in terms of inflation, that a lot of it comes down to policies under the government. Do they look beyond that? Not too sure, quite frankly. Now, if you look at market expectations, markets do expect to see a rate cut coming in August, with a second one likely coming in November or December. So markets are expecting action from the Bank of England. It's just that they are stuck between high inflation and a worsening economy. So when will they act? Markets very confident they won't act this time around, just 11% chance of a rate cut. But August, people do feel quite confident in that. So you've got the 58% for a move down to 4% and 7% for a move down to 3.75. So what you're looking at here is a likely rate cut coming in August. How do we see the likes of Bailey and Co. informing markets on both their expectations for rates at the next meeting, but also towards the back end of the year? How are they viewing inflation? Are they viewing the weakness in terms of the economy as a short-term effect of the tariff uncertainty and the like? So there's a lot to pick through when it comes to this Bank of England report, and there's a lot of uncertainty over exactly what the Bank of England are going to be able to do as we go forward. Notably, one of the charts that I've been talking about over the past week is Euro Sterling. So I just want to bring Euro Sterling up for you quickly and just look at that from a weekly perspective. So the week that we're seeing at the moment looks like it's pretty much the best week that we've seen since sort of March, April time. And if you look at the trajectory of price action over the course of the past few months on the daily time frame, you could see we did have the potential for this inverse head and shoulders formation, the creation of higher lows, higher highs, and with a break up through this neckline that we have around sort of roughly, we're trying to sort of, there you go, around there, 0.845. With the breakthrough there, to me, that started to point towards this likely moving towards the upside. And certainly from a risk to reward perspective, the fact that we saw such a strong move higher, a strong move lower, it does point towards a possibility of a similarly strong period for Euro Sterling. Now, you could say, why would the Euro strengthen and why would the pound deteriorate? Because ultimately the Eurozone have got inflation under control. They can continue to cut rates. The Bank of England has its hands tied, or at least one hand tied, because of elevated inflation. Correct. However, the ECB are pretty much closing in on the end of their easing process. The Bank of England have had a stop-start process, and at some point they're going to have to ramp up their easing. Now, yes, the inflation problem is there, but the weakness we've seen in terms of the economic data do point towards a need for the Bank of England to take some action. And so it's all about relative movement. So we're going to see a relatively dovish shift. Well, because we've already seen a cautious approach from the Bank of England, there's a good chance that we do see that. They've got the room to move into. Are we going to see a really dovish shift from the ECB? Probably not, because they've already done a lot of the heavy lifting when it comes to easing. So it does provide the backdrop for a potential rebound when it comes to Euro Sterling. That's what's playing out at the moment. Let's go on to the hourly time frame. can see here that this latest pop leaves the sort of 0.847 level as your swing low. So as we pull back, maybe we come into this zone, but unless we break the 8477 mark, I do think that this near-term recovery phase for euro sterling looks likely to continue. And then finally, let's just jump on to Japan. Now, Japan, we've got a rate decision taking place overnight, Monday going into Tuesday. Markets expecting that to remain at 0.5%. We have got weakness expected for the export figures. You can see that minus 5%. Then we've got inflation coming out at the back end of the week. As you see, 3.6% expected on both headline and core. So elevated inflation. Now, how would you drive down inflation? You would potentially have a tighter monetary policy, and they have been raising rates. Are they going to do so to a greater degree? Potentially not. They might slow down somewhat, and part of that comes down to the elevated rate of borrowing in Japan. If they are to raise interest rates, that could have a effect of driving up yields. Now, the Japanese are one of the most heavily indebted countries in the world, 250+% debt to GDP ratio. So they have a lot of debt, and ultimately they are trying to move away from the BoJ, essentially providing the funding for that and moving towards markets doing so. And so with sort of when you're taking away some of that support from a sort of state level or from a centralized level, and you try to put it on the markets, you see how much people require in terms of a return to take on that product. And you can see the price keeps going up, and it's going to cost them more and more. It's going to put them more into debt. So from that perspective, the idea of raising rates right now is not ideal. Like we said, inflation is elevated. You can see here that the Tokyo CPI figure was largely flat last time around. That points towards something quite similar in terms of the headline sort of nationwide figure that you see here, because Tokyo generally leads the nationwide figure. So mid threes we've got in terms of inflation. So problematic, but not necessarily in a position where right now we're going to see big movement in terms of rates. And this is what I was pointing to in terms of the move that we've seen from a position where it's by and large the issuing of bonds being taken up by the BoJ. And now we're seeing a more of a mix and more of a push towards the markets taking some of them. And when the markets take on more of the load, then the prices often go up as well. That's problematic, and that can put pressure on the Bank of Japan to hold off. Now, in terms of market expectations, where do we see the next rate hike? Markets pricing a move in December. So in actual fact, pushing it further out, we've just seen claims at the back end of this week just gone that it could be Q1 2026. So markets really expecting to see a lower for longer stance from the BoJ. That provides the basis for potential weakness. And the caveat to this is that at the time where you're seeing people potentially looking for havens, the US dollar is doing the complete opposite, right? So right now, the US dollar is not a good haven. So if markets are rolling over, or people are becoming fearful about something, for example, when, we hear about potential for attacks on the nuclear facilities in Iran, things like that, what haven do you go to? Well, you're more likely to go into the Japanese yen or the Swiss franc or gold than the US dollar, because the dollar keeps falling. And so for that reason, if we're talking about the potential for weakness in the Japanese yen, if we do see them sort of pushing that rate cut out further into 2026, then you're looking at trying to find something like the Swissy, because the Swissy is also a haven. And so if we look at the sort of long-term perspective here, you've got an uptrend that's in play here for the Swiss franc against the Japanese yen. More recently, just in this week, just gone, we've broken through resistance, breaking into the highest level since November 2024. Over the near term, you can see that essentially price action has been like this, right? So it's like a ascending triangle, pretty much. Symmetrical triangle, I guess. But we're breaking higher. You can see utilizing this trend line as support and now pushing towards the upside. So for me, it's a case of looking out for these swing lows and utilizing those. A breakthrough 175.88 starts to negate this breakout and start to point towards a move back into this consolidation range. But until that happens, I think there's a good chance we see further upside taking hold here for the Swiss franc against the Japanese yen, because there's a good chance that if we see weakness for equity markets and people are looking for a haven, I think there's a good chance that we see that haven coming in the forward on the Swissy rather than the Japanese yen. So that is how I'm seeing it at the moment. Certainly an interesting pair to look out for, but I'd probably trade that over the US dollar against the Japanese yen at the moment, because quite frankly, the US dollar just keeps losing ground. I wouldn't really want to be long the greenback at the moment. Hope this has been useful. Again, really busy, an interesting week ahead with plenty for traders to sink their teeth into. As ever, like, subscribe, follow for more. My name's Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day.